CEO Brian Moynihan, who started at the beginning of the year at this bank, at least in the CEO's position. He had many executive spots before that, has been working very hard to reverse losses from credit cards and home loans, and the credit picture for Bank of America most definitely improved this morning. He is with us from Charlotte, North Carolina. Brian, it is always good to have you. Let's try to put this in perspective. Yesterday, everybody started to get excited about the potential for buybacks and maybe even a dividend increase from some of the biggest banks on Wall Street. You've got a positive earnings report. You beat Wall Street estimates. You are accumulating capital. At what point are you going to be in a position to buy back stock and possibly raise the dividend?
I think we've got a few more quarters to go to make sure that we see the economy cleared up. We see how the new capital rules will play out. We've built significant capital. We've been restructuring the company, continue to make good improvement in that, and we sold some investments to help with our capital ratios this quarter. But I think we still got some quarters to go until we see consistent earnings, the credit quality consistently getting better. It's been getting better each quarter, but really behind us. And importantly, make sure that the uncertainty of the capital rules, the financial regulation all comes together, and so it's out there a bit.
Brian, you were the first CEO of a big bank on Wall Street to call the turn in the credit markets. It was in a conversation that we had, in fact, at the beginning of the year, just after you took over as CEO. You just mentioned that credit quality has been improving, but there is still some ways to go. Give me a percentage when you look at the U.S. consumer, the person to whom you're making loans on credit cards, the person to whom you've got loans on mortgages. How far along is he in the credit market recovery? Is it 50%, 60%, 70%? How much further do we have to go?
I would look at that the other way around, just look at the delinquency percentages. And so in the card business, we're still running in double digits, and we should, in a more normalized basis, be running around 5, maybe 5 to 6%. That's what we believe. So you still have some room to go. From an individual consumer, it's a little bit more binary. Either they have good credit and they're great and they're fine, or they don't have good credit. So, but from an aggregate, I'd say in the end, our company's about halfway back to where it should be, and we'll see continued improvement in the subsequent quarters.
About halfway back, that's a pretty encouraging sign. Let's talk, Brian, for a moment about one of the main factors that has really helped to buoy bank earnings in this recovery from the recession, margins, or at least lending margins effectively. With the Fed lending to banks at almost 0%, it has been possible to make a fair amount of money on your credit portfolio. But I noticed that net interest income for Bank of America is down in the second quarter from the first quarter, and we have seen the yield curve begin to flatten a bit. How do you think that's going to play out in the third quarter and the fourth quarter?
We've been clear with people. One of the areas that's under pressure for us is our net interest margin. And one of the reasons for that, Eric, is that everybody thinks about the dynamic you just talked about, but the real dynamic is with interest rates near zero, the value of the deposit franchise, because we don't pay people less than zero for their deposits, so the value of the deposit franchise is actually not as valuable as it will be as interest rates rise. And so, unless you want to take significant outgo risk, this is not a friendly time for banking in terms of their net interest margins. It'll take several quarters for the interest rate environment to, if the economy is growing, the interest rates to rise, and then we'll be in better shape on the other side.
Let's talk about your view, though, of where the economy is headed in terms of interest rates. At what point do you think the Fed is going to be in a position to raise interest rates? Right now, it looks like we're pretty much, if not on the border, on the cusp of deflation.
Well, I'm not trained as a theoretical economist, so I've got to rely on what my experts tell me in some ways. But as we look at the consumer and corporate activity, you've seen it get better. You've seen it stabilize. You've seen people not lay off people. You see people quit paying off their loans and sort of stabilize loan balances on the commercial customer side. So when we look forward in the second half, our experts think growth of 2.5% to 2% or so, a little bit higher than that in the economy in the U.S. Europe will still be difficult, and Asia will grow faster as we think about our business around the world. So I'd say that whether it's deflation or whatever, we're in a period of sort of muddling along in this economy, and it's going to take a few more quarters or several more quarters, I think, for you to see the sustained sustained activity. It is better this year than last year. It's better this year than it was, significantly better than 2 years ago, obviously. But I think we're still working through, and I think it's going to just take time to get the unemployment numbers are going to be sticky and things. So I think we're sort of in a state of sort of moving through the muck, and yet we're moving in the right direction, I think.
Brian, can you put a number for us on the impact of regulatory reform? The Senate passing it. It's now ready for the president to sign. What kind of dent is it going to put in Bank of America's profits?
Well, I think there are. Everybody focuses on the Dodd-Frank bill, but you have to also look at the impact of the CARD Act and Reg E to bank P&Ls, and we've been clear each quarter about the impact of those. And you put it all together, there's really two broad groups that are affected by the regulations in the scheme: the consumer business and then in the capital markets business. Now there's pieces that affect everything, but in two broad pieces. And most of the money that we're going to have to deal with is on the consumer side, and we've been clear this is billions of dollars of lost revenue that we're going to have to figure out how to make up over the next 2, 3, 5 years through shifting how we charge consumers. We give tremendous value. 6,000 branches, 18,000 ATMs, an online services is second to none with more people by far than anybody uses it. Mobile banking, which is second to none. Text banking. We have all these services, and the consumers appreciate them. The issue is that the way we charged before and the way we're going to charge in the future is going to have to shift. And because if we can't make a return, we can't provide the services. And so you're going to see this shift. So it's billions of dollars, and it affects our revenue run rate, and it'll affect carrying value of some assets over time. And we're going to be clear. We'll talk about that later today with with the analysts and shareholders. But the key is that there's ways to make it up. It just takes time. And we believe it's a fair way to treat the consumer over time that's embedded in some of this. It's not all pleasant, but we'll get through it. But it moves away from penalty pricing more into broad-based pricing, which we think is better for the overall consumer and clearly better for the consumers who found themselves with high fees and high penalty fees, overdraft fees, and things like that.
Brian, one subject we haven't touched on, but we need to, is investment banking and trading. The numbers are down from the first quarter, and to some people that's no surprise given the fact that the second quarter was the quarter of the flash crash. A whole lot of volatility, customers on the sidelines. You've got $2.6 billion in fixed income revenue, $1 billion in equity trading revenue. Is that the run rate we should expect from Bank of America over the next couple of quarters?
Well, let's sort investment banking revenue away from the sales and trading. Investment banking revenue is actually up, and we became the #1 investment bank in the U.S. and #2 in the world, and almost have closed the distance to the #1 competitor. So in investment banking, we actually had another strong quarter on a relative basis, and actually strong quarter on an absolute basis. When you get to the sales and trading, that business will earn about 10% of what it earned in the first quarter and the second quarter. I think neither one of those is actually the run rate. The first quarter is fabulous, and Tom Montag and team had a great quarter. This quarter, they're down more than I said, so we'd expect that to come up in the future. And in fact, even the second quarter was 3 different months between April, May, and June. And in June, we saw the revenue come back a bit, and we're seeing that hold. So I think we'll move back to a more normalized level. It won't be what it was in the first quarter, and now we're in the summer too, so you got to be careful. But it'll move back above what it was this quarter. Now, the good news is the team did a great job of managing the risk. We made money, and not only revenue but profit, and that's a pretty powerful thing. And overall, with even that drop in profit in that area, it shows the resiliency of our company. We made $3 billion round numbers first quarter, $3 billion round numbers second quarter, and the trading business contribution dropped by 80 to 90%, which shows you our other businesses can come up and make the difference. And so this quarter has lots of activities in it, but at the end of the day, we continue to make money, sort of despite what's thrown at us.
Brian, it is always a pleasure to have you here. Brian Moynihan, the CEO of Bank of America, live from Charlotte this morning.